The Fed just bought $34.8 billion in 10-year bonds over 2 days, and then I think somewhere in the neighborhood of $20 billion in 3-year treasuries. What does that say? I mean, that to me says that there is virtually no demand for our treasuries, that the Fed is resorting to quiet, stealth quantitative easing through their SOMA group, that they're not talking about it. They say they're still shedding treasuries and mortgage-backed securities off of their balance sheet, yet they're loading up quietly on 3 and 10-year, which is a form of yield curve control. We have tariffs that, on one hand, I could say they're noble in their pursuit of reshoring strategic and critical manufacturing centers, like for, AI or microchips or pharmaceuticals or steel or airplane parts, things that we need for the security and the national security at that of this country, for sure. But, we also have to remember Triffin's dilemma, which more or less says that if the world runs on US dollars, that they will always require more dollars than we can provide just in global trade. And so we have to export dollars, which ultimately ends up through various factors eviscerating our manufacturing. We will always run a trade imbalance if we are the world reserve currency, but it is that process of selling or buying the world's goods with US dollars and then expecting them to reinvest the proceeds in US treasuries that has kept our interest rates low and our goods cheap and our asset prices high and our standard of living higher. There's a problem here. You can't probably have both. It almost seems to me that the administration has come to this realization, that they realize that perhaps being the world reserve currency isn't as glamorous as it once was, or as vital as it once was, and perhaps becoming more independent and self-reliant rather than relying on everyone else for the things that we need in this country, from military equipment to pharmaceuticals, maybe has greater importance. I think that there's a lot of smoke and mirrors. They tell us on paper that inflation's getting cheaper, yet everywhere I look, it just seems that the cost of living is getting higher, whether it be tuition or insurance or food or, everything seems to be getting more expensive, yet we're told that inflation is coming down. And when you see the Fed step in and buy, in essence, over $50 billion worth of treasuries, well, what does that tell you? That tells you that inflation should reemerge. It tells you that there's not a huge demand for our treasuries. And it tells you that enacting these tariffs maybe are somewhat misplaced, that the rest of the world is saying, if it's going to be that way, we would rather establish other trade channels. We would rather buy other things that act as a reserve asset like gold with no counterparty risk. And we would rather trade our stuff for US dollars. So yeah, I think that this reemergence of risk on trade is foolhardy, is silly, short-sighted at that. And I don't know, call me old-fashioned, but I think this is not the time to be focusing of return on. It's more along the lines of focusing on return of your money. Despite offering right now, you got 4.5% on the 10-year treasury. They wanted it lower than that. You could argue that the demand for the bonds is fading very fast, and the Fed has to come in and buy the 3 and the 10-year at the same time that they've been paying 4% interest. Since January, the dollar's lost over 9%, reflecting, I believe, a broader loss in confidence of the dollar as a safe haven in the global markets. And this is a big deal. And they're not saying, or not really publicly talking about, the fact that they're coming in and intervening in a form of yield curve control, trying to keep the rates low. And even with that being said, the rates keep creeping higher. And that's the market's way of saying, no, we're stronger than you are, Federal Reserve. The market, this is a massive market. And if the Fed were to really come in and start to intervene, you're talking hyperinflation, to print all of that money, to come in and buy those treasuries to keep yields down, which is the same problem that we got into at the very beginning. The whole crux of all of this, let's say all of the distortions, and not only in asset prices and asset values, but misallocations in the way resources were deployed and capital was deployed, and incentivizing debt, is because of suppression of interest rates. And we haven't learned our lesson. You go back to 2008, the Fed's balance sheet was $800 billion. It's over $6 trillion now. It was at $9 trillion at one point during the pandemic. But all of that money that the Fed has spent and added to their balance sheet has been in the form of mortgage-backed securities or treasuries, or during the pandemic expanded into government bonds, which they shouldn't do. But these are all things that are incentivized to bring interest rates down, to continue to, foster this illusion of easy money and strong dollar and Well, the game is rapidly coming to an end in the respect that we owe roughly $28 trillion worth of debt or bond payments that come due in 2028. And we're at best will take in 15 trillion in tax revenue. He's talking about lowering taxes. That gets us halfway there. And you have Trump asking to jack up the debt ceiling. Doge has only saved us about $250 billion or so, not the $2 trillion that they had thought they could make because Congress isn't really cooperating. And so at the same time, we have Doge trying to eliminate waste and fraud. We have more irresponsible fiscal policy and quiet stealth QE by the Fed monetary policy. This is why part of the reason, on top of sanctions, or what do you call them, tariffs masquerading as sanctions or flat out sanctions, along with the realization that we're in a very bad place with interest rates and inflation, even to the point where Powell had to come out and say that he's actually contemplating perhaps abandoning the dual mandate, in the respect that how can you keep inflation low and not let it get away? And at the same time, if no one's buying our treasuries, how do you finance the debt? Well, it looks like quietly Soma came in and started buying treasuries because of this. And the information or the reporting by the Bureau of Labor Statistics that keeps saying inflation is getting low. Well, I don't know. Maybe they don't shop or travel the same places that I do, but it doesn't seem to me that the cost of living is decreasing. In fact, every single day, month, and year, it seems to be getting more expensive. So we're in a sticky wicket right now. And this is just another sign of it. And I think the world has grown tired of taking our debt, realizing that we sanction, we inflate. And, why would you want to sell goods to a country for dollars that can be created out of thin air and then put the proceeds, the excess reserves, into treasuries that the Fed can just create money out of thin air and buy 50 billion worth like that? It's almost immoral. It's stupid. And I think the rest of the world is finally catching on to that. It's a problem. And I think it portrays for bigger problems ahead. Yeah, I think maybe that's why he backed off, realizing that going down this road would lead to empty shelves. I was watching something the other day where there wasn't any container ships whatsoever in the port in Seattle. And again, remember, these are the countries, through buying our treasuries and or taking our dollars for their goods, have allowed us to live this standard of living that is far above what arguably we deserve by keeping rates low and asset prices high and goods cheap. And that's a problem when you start to see things move in that direction. You have empty shelves, you have rising rates, you have a slowing economy, you have layoffs, you have stagflation, higher inflation, and little or no economic growth. And that's why you keep hearing that word come around. And that's why they want rates lower. And if you can't really do both at the same time, probably the lesser of the two evils in this scenario is higher inflation, because we are so far indebted with such low levels of saving. Maintaining or maintenance of that debt becomes very difficult as rates go higher, especially anything that is variable rate debt. It becomes next to impossible in an economy that is slowing, where you see layoffs because rates are going higher and goods are becoming tougher, and the supply chain distortions can't make your goods if a lot of the products that go into the finished product come from countries that we are imposing tariffs on. I just think that it would be much easier just to simply say we are unilaterally going to move away from being the world reserve currency and move to a more fair balance of trade. That's one thing. But to push tariffs on countries and we expect them to continue to take the dollar and take treasuries, it's a problem for being the world reserve currency. Countries will just find other avenues. And that is what we are seeing happen. And, there's over 40 countries that have applied to the BRICS now, but there's bigger news in terms of the expansion of the BRICS under the covers that no one's talking about. And, I started talking about the BRICS 5 years ago, and I was maybe one of the first, if not the. Now I'm talking about something that I don't hear anyone talking about that I think pushes back against the naysayers and the objections that were often given about the BRICS. So when you talk about the dollar milkshake theory, Brent Johnson's genius. He's been right all along, but it's getting to the point now where the desire to hold our debt and to sell for dollars and to reinvest in treasuries and to continue to feed this machine is waning. And what we will see is a period of greater inflation. We will see a period of greater de-dollarization. And this could be like the snap of a finger, like the Operation Sandman. Now, I'm not saying that's going to happen, but that's what they could potentially do. They're playing both sides. You have the Crown Prince of Saudi Arabia on one hand shaking, Xi Jinping's hand and saying, we're with you. And then on the other hand, shaking Trump's hand. They're playing both sides for now. But the inroads that are being built the infrastructure that is being built is far, far surpassing what any of us who analyze BRICS ever thought, and yet no one's talking about it. So I think that all of these things right now are just a spot in a circle. We haven't gotten to the inflection point yet, but you can see it's moving in that direction, whether it be the massive importing of gold into the United States, huge amounts, largest deliveries ever, and of silver, or things that are going on around the rest of the world. It's about to get very interesting, and maybe not in the best way for the United States. And the tariffs potentially are what are accelerating this trend.